Today, we are diving deep into the engine that powers pretty much every single business decision on the planet. We're talking about the constant, crucial calculation between risk and return.
So what's it going to be? High risk or high reward? It's the ultimate question, isn't it? You can play it safe, for a small, steady gain. Or you can go for that big prize and risk walking away with absolutely nothing. This isn't just a game show dilemma. This is the central challenge, right at the heart of all business strategy.
And that's exactly what we're looking at. Think of it like a tug of war. Every decision you make is this constant balancing act between these two powerful forces, risk and reward. And honestly, understanding how to manage this balance is what separates a business that thrives from one that just fizzles out.
Okay, so let's get into it. Let's really break down this high-stakes balancing act. What is this fundamental trade-off all about? What are we really weighing here?
It's easiest if you think of them as two sides of the very same coin. On one side, you've got risk. That's all the uncertainty, all the what-ifs. Then you flip it over and you've got return. That's the potential reward you get for facing down that uncertainty. The thing is, you just can't have one without the other.
Let's just focus on risk for a quick second. The most important word here, uncertainty. Risk isn't a guarantee that something bad will happen. Not at all. It's the possibility of it. It's the great unknown of the business world.
And here's its partner in crime, return. See how it's directly tied to taking on a risk? Return is the profit, the growth, the market share. It's the whole reason anyone bothers to take a chance in the first place.
So here's the absolute crux of it. If you want a shot at those really big rewards, you generally have to be willing to take on a higher level of risk. They're totally connected. It's kind of like the price of admission for a chance to win the jackpot.
And yeah, this is the part that's a bit of a buzzkill. That same ticket that gives you a shot at a huge win, it also carries a much bigger potential for loss. It's a classic double-edged sword.
So what if you say, forget it, I'm just going to avoid all risk? I mean, it might feel safer, sure, but what you're really doing is putting a hard ceiling on your own potential. When you eliminate risk, you also eliminate any real chance for meaningful growth. No risk, no reward. That, right there, is the risk-return trade-off in a nutshell.
Okay, so knowing the trade-off is one thing. But how do the really successful businesses actually, deal with it? Well, the secret isn't about avoiding risk. It's about taming it.
Smart companies, they have a playbook for this. First, they just identify everything that could possibly go wrong. Then they look at each one and assess it. How likely is this to happen? And if it does, how bad is the damage going to be? And finally, they build a real plan, a strategy to manage that threat. It's all about having a structured way to deal with all that uncertainty.
And believe me, these risks come in all shapes and sizes. You've got financial risk, like a sudden market crash. There's operational risk, maybe a key supply chain link breaks. Market risk is a big one. What if a new competitor just swoops in and steals your customers? And of course, technological risk, where a critical system just goes down. Every business has its own unique cocktail of these threats.
Let's make this super simple. Imagine you're launching a cool new gadget. Right away, you're facing market risk. Are people actually going to buy this thing? And you're also facing operational risk. Can our factories even produce enough of them if people do want to buy it? See, every big move has layers of risk. So this all sounds pretty good in theory, right? But let's see how this stuff actually plays out in the real world. It's time to go from theory to triumph with a fantastic case study. Because this is really where the rubber meets the road. How does a company stare down massive uncertainty and still come out on top? So let's take a look at the Indonesian fintech sector. The market for digital payments there was, to put it mildly, an absolute battleground. Incredibly crowded, fiercely competitive. So any new company coming in faced a monumental challenge. You had to invest a ton of money with absolutely zero guarantee of success. And yet, companies like OVO and Dana decided to jump headfirst into this high-risk world. So what did they do? They didn't just cross their fingers and hope for the best. No way. They actively managed their risks. They navigated all these complex regulations and built these incredibly robust systems that could handle a massive number of transactions. And here it is, the payoff. By taking that huge, calculated risk and managing it intelligently, they got a massive return. We're talking widespread user adoption and powerful brand recognition in a market where everyone was fighting for attention. It's a perfect example of the risk-return principle in action.
Okay, let's pull all of this together. Let's figure out the core lesson here for all of us. What is the final equation?
And this, right here, is the single most important thing to remember. Success isn't about finding some magical path with zero risk. That path, it doesn't lead anywhere interesting. The real goal, the true skill, is learning how to manage risk intelligently so you can unlock the potential for a real reward.
And that really leaves us with a question to chew on, doesn't it? Whether it's in your career, an investment you're thinking about, or maybe even a personal project, what calculated risk is out there, waiting for you, that could unlock your next big return? What's the smart chance you could take?